If you want to understand e-commerce in Latin America, picture a single company performing the roles of Amazon, Shopify, FedEx, and PayPal combined. That is Mercado Libre. This chart shows the disconnect that caught investors off guard. On the left, Mercado Libre posted $8.85 billion in Q1 2026 revenue, a 49% growth rate. Yet immediately after reporting those numbers, the stock plummeted 13%. Look at the operating margins. They fell from 12.9% a year ago to just 6.9%. That 600 basis point drop is the reason the market corrected, even as the top-line revenue hit record highs. For anyone holding this stock, you have to answer one practical question. Is this margin collapse a flaw in the business or a deliberate investment cycle? Institutional investors trade on 90-day cycles. When a company misses its short-term profit estimates, modern markets punish the stock, regardless of the long-term vision. But Mercado Libre's management is actively choosing to sacrifice short-term profitability to guarantee regional market dominance. To value this company correctly, we have to look past the quarterly earnings cycle and examine the expensive ecosystem moats they are building with that cash. First, look at physical logistics. Mercado Envíos is expanding its physical fulfillment centers across Latin America to own the region's delivery infrastructure. This flowchart tracks how they deploy capital. Management lowered the free shipping threshold in Brazil, squeezing margins to capture market share. The operational outcome is a clear advantage. Today, 75% of shipments arrive in under 48 hours. This speed is a direct countermeasure against global giants. Amazon is trying to encroach by offering zero-fee structures for new sellers in Brazil. At the same time, low-cost Asian competitors like Shopee and Shein are flooding the market with cheap cross-border goods, subsidized by heavy promotions. This physical network acts as a structural defense against these rivals. While cross-border competitors rely on long-haul transit, Mercado Libre's local infrastructure allows for same-day delivery that global models cannot replicate. But maintaining that network is expensive. Subsidizing shipping and building warehouses is exactly what took 600 basis points off their operating margins. You are effectively paying for physical market share with your quarterly profits. It is the trade-off required to keep Amazon and Shopee from taking root. The second massive cash sink is digital banking. Mercado Pago has evolved from a simple payment processor into a complete digital wallet. They are scaling a $12.5 billion credit portfolio, issuing loans and credit cards directly to unbanked and underbanked consumers. This chart shows the strategy's growth. Total payment volume surged 50%, hitting $87.2 billion, locking users in. But there's a cost. They set aside $1.24 billion this quarter as provisions for doubtful accounts. Money borrowers may never pay back. Issuing unsecured credit to the unbanked in Latin America carries higher default risks than operating a standard bank in a developed market. The macroeconomic realities are volatile. Inflation spikes and currency devaluations in countries like Argentina and Brazil instantly impact a consumer's ability to repay a loan. The upside to this risk is user lock-in. A customer who relies on Mercado Libre for both their daily shopping and their primary bank account is highly unlikely to leave. While the fintech arm drives high-velocity expansion, it exposes the investor to regional credit default risks that are absent in a pure e-commerce model. Buying into this ecosystem today means paying a premium. The stock trades at a 43 times price-to-earnings ratio. Investors pay that multiple because the company delivers compounding 30 to 40% annual revenue growth and operates a rapidly scaling high-margin advertising business. However, a stock trading at 43 times earnings is sensitive to any disappointment. Pure digital bank without logistics overhead, Nu achieves a 25% return on equity at a lower 19 times earnings multiple. But there's a trade-off. A high 7.9% bad loan ratio concentrates your risk entirely in consumer banking. Mercado Libre demands a premium for its diversified ecosystem. Nu offers cheaper exposure, but requires you to accept concentrated credit risk. Mercado Libre is playing a 10-year game for market dominance, trading inside a market that is focused on 90-day earnings. The current margin crunch is a tool used to starve competitors. It is not a failure of management. This quadrant chart maps who should actually buy this stock based on their individual strategy. If you are a high-conviction growth investor with a 5-year horizon, this is a strong fit. You can stomach the margin drops because you view them as long-term moat building. If you are a value optimizer, this is a poor fit. The 43x multiple and intentional profit sacrifices will cause too much volatility for your portfolio. And if you are a pure fintech bull, look at new holdings to avoid logistics capital expenditures entirely, assuming you accept the concentrated banking risk. Do not buy Mercado Libre expecting a smooth, low volatility ride. Buy it only if you believe an iron grip on Latin American logistics and payments is worth paying a premium for today.